Are Canadian bond yields climbing toward a shocking 5%? You've probably heard the headlines warning about soaring yields, but is that the whole story? Today we're peeling back the layers to uncover the truth about Canada's bond market. Spoiler alert, the numbers don't support the hype. Let's explore what's happening with the bond yields, why they're far from 5%, and what it means for your financial future. Think about this briefly. When you hear bond yields, what comes to your mind? Volatility? Market panic? What if I told you Canada's 5-year bond yield as of November 14, 2024 is a steady 3.13%? That's far from 5% level, causing concern. So what's behind the confusion? Let's break it down to simple terms. We must ground ourselves in the fundamental truths regarding bond yields. To begin our discussion, essentially, bond yields are a critical indicator reflecting the returns that investors receive from government-issued bonds. This financial metric is not static. It fluctuates, influenced by various factors, including central bank policies, prevailing inflation rates, and the broader market sentiment. Each of these elements play a pivotal role in shaping investor expectations and decisions, illustrating the dynamic nature of financial markets. Understanding this interplay is crucial for anyone looking to navigate the world of investment effectively. Here's where we stand as of November 2024. The 5-year bond yield, 3.13%, 10-year bond yield, 3.28%, and the 2-year bond yield, 3.15%. The 30-year bond yield is 3.28%. To give you some perspective, the historical high for Canada's 5-year bond yield was 4.47% in October of 2007. Fast forward to today, and we're well below the threshold for most of this last decade. Canadian bond yields have hovered between 2% and 4%, which is considered stable, particularly compared to the double-digit yields of 1980. The stability presents a favorable outlook for investors, creating a landscape in which predictable returns are not just optimistic expectation, but a reliable reality. A consistent market environment also contributes to lower borrowing costs, lowering businesses and individuals to access necessary funds without the burden of exorbitant interest rates. Furthermore, this assurance leads to fewer expected developments in the broader financial market, enabling investors to make more informed decisions and confidently plan for the future. This stability fosters trust and predictability, which are essential for thriving investment climate. So why are people talking about 5%? Despite the data, there is a persistent narrative that the bond yields are climbing toward 5%. Why? It boils down to market psychology and headlines that exaggerate reality, hoping you'll buy some more bonds. Like any financial market, bond markets are influenced by perception as much as actual data. When inflation rises or central banks adjust their policies, speculation tends to spiral. People fear worst-case scenario, leading to exaggerated claims about where yields might go. The yield on the 5-year bond is anticipated to decrease to 3.3% by the end of this quarter. Looking ahead to the following year, financial analysts forecast an even further decline, projecting the yield to settle at approximately 2.91%. The data from Trading Economics supports this outlook, indicating that these forecasts reflect a trend of gradual cooling in the financial markets rather than any form of escalation. Therefore, despite what some speculators' narratives might imply about potential yield spikes, the underlying reality appears to be considerably more subdued and less dramatic than those predicting surge. Central banks' decision that the Bank of Canada plays a central role in shaping the bond yields. When it raises or cuts interest rates, the ripple effect is immediate. Over the past year, the Bank of Canada shifted toward rate cuts to stabilize the economy. For example, the recent quarter point reduction encouraged borrowing and investment. Rate cuts generally reduce bond yields because they're signaling low borrowing costs and stable inflation environment. Historically, during rate cuts, yields tend to decrease across the board. These trends align with the current market environment, keeping yields below 5%. Inflation is another critical factor. Higher inflation erodes money purchasing power, leading investors to demand higher yields as compensation. However, Canada's inflation story is one stabilization. After peaking at 8.1% in mid-2022, the highest level in decades, inflation has steadily declined to more manageable levels. Today, it hovers close to the Bank of Canada's 2% target. This downward trend in inflation eases pressure on the bond yields, making it unlikely that they will reach 5% soon. Economic resilience. According to most measures, Canada's economy is performing well. GDP growth is steady, unemployment is low, and consumer spending remains robust. This factor creates a favorable backdrop for bond markets, as solid economic fundamentals generally support stable yields. The government spending and borrowing. While government borrowing can sometimes put yields higher, Canada has avoided excessive debt accumulation. Recent fiscal policies have focused on target spending, thinking infrastructure and green energy investments without overwhelming the bond market. What recent trends tell us? The bond markets have been volatile recently, driven by global economic uncertainty and fluctuation market sentiment. However, the key takeaway to this volatility does not equate to unsustainable growth in yields. The recent trends have shown investment-grade corporate bonds and structural products outperform government bonds of similar durations. Investors are drawn to these alternatives because of the higher yields and relatively low risk. For example, a corporate bond with a yield of 3.5% might outperform a government bond yielding 1.3%. This slight difference have a big impact on income-focused investors. While 5% remains unlikely, now let's address the big question. What would it take for Canada's bond yields to hit 5%? Runaway inflation? Inflation could need to soar well beyond current levels. We're talking double-digit inflation rates, sustained over months or even years, to increasingly unlikely scenarios. Aggressive central bank tightening. The Bank of Canada would need to reverse its rate cuts and pursue aggressive rate hikes. However, this would only happen if inflation became uncontrollable, which is not reflected in current data. Economic weakness or credit concerns. A significant downturn in Canada's economy or questions about its creditworthiness could increase yields as investors demand more compensation for risk. However, with Canada's AAA credit rating intact and economy growing steadily, the scenario seems improbable. These factors suggest that the 5% yield environment is far from reality. So what should investors do now? If you're an investor, this stable bond environment offers some unique opportunities. Diversify your portfolio. Bonds provide a hedge against stock market volatility. Adding government or corporate bonds to your portfolio can reduce overall risk. Look at fixed income alternatives for higher yields. Consider exploring corporate bonds or structured products in stable market conditions. These options often outperform government bonds. And please stay informed. Monitor central bank announcements, inflation data, and global economic events. These indicators will help you make smarter investment decisions. Canada's bond market is steady, not surging, at 3.13%, and the 5-year bond yield is far from feared 5% mark. Forecasts even suggest slight declines in the months ahead. But the bond market doesn't exist in a vacuum. Central bank policies, inflation trends, and market sentiment influence it. Staying informed about these dynamics is the best way to navigate the opportunities and risks in today's market. So what's your take? Are bond yields safe in environment or are you exploring other investments? Let me know in the comments below. Please like, share and subscribe to the channel. If this analysis helps, let's make smarter financial decisions together.